Good day friends. Today we are starting a new subject on financial markets and institutions. In this lecture series on financial markets and institution, in today's lecture I will be talking about introduction to financial system. And friends, in today's lecture on introduction to financial system, I will be talking of various terms, concepts which we will be discussing in the various lectures which will be discussed in the financial markets and institution subject as such. So in this lecture series, there will be 30-40 lectures on this financial markets and institutions. So I will be giving you the broad idea about the financial markets and institution in this lecture. So to start with, let's understand what the financial system means. What is financial system? What we mean by system, let's understand first. System consists of various parts which are interrelated and interconnected and which constitutes as a whole a workable system, and that the objective of this workable system is to achieve a common goal, a particular goal. So what it means is, system is a integrated and interconnected parts of the various system. Similarly, in the financial system also, there are various parts, various components of the financial systems which makes a system. Just to give you an example, like banks, financial institutions, stock exchanges, insurance companies, regulators like SEBI, RBI. Broadly, these are the various components, these are the various parts, various subsystems which makes the whole entire the financial system. So put it this way, a system is a set of various interconnected constituents, parts, forming a complex whole in order to achieve a goal. Likewise, financial system also consists of various interconnected parts to achieve common goal that connects lenders and borrowers. We say human body is a part, and in the human body there are various parts, which these parts, there are various organs, there are various parts which these organs are quite closely related to each other, and these parts makes a human body which has its particular function which forms a particular system. Similarly, financial system also has the various parts which I have just talked about, and the objective of the financial system is to connect lenders and borrowers. So an efficient, vibrant and developed financial system is essential for rapid economic development. If you see any developed country and if you see the financial system of that country, you will find that it has good banking system, it has good regulations, it has good insurance system, it has good merchant banking system, stock exchanges. So there are various components of these financial systems which are developed and which helps in capital formation of the country. What we mean by capital formation is that savings, channelizing the savings, and investment. Those who are ready to invest, those who needs money, these subsystems or these parts of the financial system channelizes the money from the lenders to the borrowers so that the productive use of money can be made. So financial system is a mechanism through which funds required by the users are supplied by the savers of the fund. Suppose I am a household, I am a person who is in the job and who earns salaries, right? Whatever I earn, a part of it is being saved by me. Part of it is being spent on my day-to-day requirements and part of it is being saved. The money which I save, I am not able to use it for productive uses unless there are certain agencies which helps me in putting my savings into productive use. There are companies, there are houses, business houses which needs money for investment, for starting new business, for establishing their factories, for starting their retail business. They need money and I have surplus money. So simply speaking, what banks do, whatever money I have, I make fixed deposits in the bank, and these banks helps the businessmen or the industrialists or the traders to to give them the money as a loan, and this money is being used by these businessmen, these traders, these industrialists for investment purposes. They make use of this money and produces income by it, produces capital formation by it, and helps in economic development. So it's a win-win situation for both of us, that is a person who has savings, who has surplus funds, and the person who needs money. So what is the bank role? Bank role is that they accept deposit from the individuals. Individuals' savings may be small, may be large, very large sum of money can be there, right? Or if there are even businessmen, even industrialists who have surplus funds and they are not finding a suitable investment opportunity. So for the time being, they park their money in the banks, they park their money with different financial institutions, and these institutions lend this money to the people who needs money. So what is the role of the financial system? What is the role of these different banks and the financial institutions? The role is they are channelizing this money from unproductive use to productive use, so that the capital formation of the country takes place, so that the productive use of the money takes place, and this is what role of the financial system is, right? So a financial system is a system through which the exchange of funds is enabled through various institutions like banks, insurance companies, stock exchanges. I'll be talking all these in detail. So it helps to channelize the surplus funds from lenders to the borrowers. It also helps in providing liquidity, price discovery, and methods through which the risk can be transferred from the hedgers to the speculators. When I use the word it provides liquidity, what it means is that suppose I invest my money in the stock market, in the shares. I buy the shares of some company, where I'll find the suitable buyer. It is the stock exchanges which helps me in buying and selling the shares. So I want liquidity of my money. Why I am saving my money? I am saving my money so that whenever any point of time I'll be using the money, I can invest, I can convert this savings, that is my investment in the form of buying the stocks, into liquid form, into cash form. So if I have bought the shares, I can sell it in the stock market, right, and it provides me liquidity. If I deposit the money in the banks, I make the deposits in the saving fund, I make the deposits in the fixed deposits. If at all any emergency arise, even I can encash my fixed deposit earlier than the required time period. So there is a liquidity that is being provided to me. So this financial system helps in providing liquidity, price discovery. If I talk of again of the stock markets, right? If a company issues the shares, unless it is being traded in some market, how the price discovery of that share will take place? What is the right price of the share? How it will take place? So it is the stock exchanges which helps in is the price discovery. See, there are commodity markets. You must have heard MCX, right? So MCX is a commodity market where the commodities are being dealt. So what will be the right price of gold? What will be the right price of silver? What is the right price of copper? What is the right price of a particular pulse and grains, right? There is a commodity market where on the basis of demand and supply, the price discovery takes place. So these are the part and parcel of these commodity markets, are the part and parcel of the financial system, right? So they helps in price discovery, right? So they helps in the financial liquidity, providing liquidity, price discovery, transfer of risk from hedgers to the speculators. So this is basically important function of the financial system, or I'd say financial markets. So there are three major functions of financial system: saving function, policy function, and credit functions. Saving functions means that the individuals who saves the money, these financial system motivate people to save more. How they motivate people? Because I know that I will able to create wealth in a long period of time by saving my income. A part of income is being saved, and if it is being put to productive use, right? Say I buy mutual fund units, I buy shares, I make back deposits. So over a period of time, my deposits will grow, and with the help of the compounding of this interest income, or if I invest in the stock market if the price of my shares increases, right, then my wealth will be created in a long period of time. So these financial institutions or the financial system helps in saving function. Means they mobilize, not only they mobilize savings, but also motivate people to save. Policy function, there are various regulators, means for stock markets, there are regulators like SEBI, Securities and Exchange Board of India. For insurance sector in India, there is a regulator called IRDAI, Insurance Regulatory Development Authority of India. For pension fund, there is another regulator. So these regulator makes the right policy so that everybody functions within the policy framework, right, so that there is a more transparency in the system, so that there are people have trust in the financial system. So the policy function is an important function of financial system. Similarly, credit function. Credit means they helps in providing credit to the borrowers who needs money. So that way, these are the three important role or functions that the financial systems play. That is saving function, policy function, and the credit function. Now let's understand what is the whole structure of Indian financial system. And today's lecture will by and large be revolving around this structure of the financial system. Or I can say, as I was saying in my introductory remarks, there are various components, various parts which are interrelated, which are interconnected, and which makes a unitary whole, which makes a system. So these are the various, I'll be talking in detail these various systems, right? So these are the various systems of the Indian financial system, or for that matter, not only Indian financial system, but the financial system as a whole throughout the world. So these components are financial institutions, financial markets, financial instruments or assets or securities, whatever we can call it, financial services, and financial regulators. So broadly, these are the five subsystems, or these are the five components of any financial system in a country, right? So institutions, market, assets or instruments, services, regulators, right? So each of these functions I'll be talking in this lecture. I've shown that these are the various structure of these are what you find is that financial system made of these various subsystems or these various parts which are related to each other, and each system affects each other. So let's start with the financial institutions. Financial institutions can again be classified in two broad categories: banking institutions and non-banking institutions. Banking institutions, normally whenever we are talking, when we are in general parlance, we talk about the financial system, the very first thing that comes in our mind is banks. Banks may be private banks, it may be public sector banks, it may be foreign banks, right? So the various banking system, I was just talking about the role of the financial system. I said it helps in mobilizing savings, it channelizing the savings of the individuals in the capital formation form, and it makes the productive use, it helps in productive use of the money. How it helps? Because what we do in the bank, you and I, what we do in the bank as an individual, whatever little savings we make, we deposit in our banks. And what banks does? Bank use this money, use our deposits for the people, for the business class people, even for the individuals who needs money, right? And they make use of this money, they channelizes this savings of the individuals to the users, means those who needs money. So these banking institutions, and the basic feature of the banking institutions is that when we talk of the commercial banks especially, that they are allowed to issue checkable deposits. This is the basic difference between banking institutions and the non-banking institutions. When I say they accept checkable deposits means I can withdraw the money at any point of time when I like, and I can issue this money. I can use this money to pay my obligations. Say I have a deposit in my bank. I have X sum of money in my saving fund account. So I have to make payment of electricity bill. I have to make payment of my water bill. I have to make payment of my house rent, and so on so forth. I have to make some payment to I make purchasing. So what I do, either through credit card or through UPI or through checks, at any point of time I can keep on issuing either checks or through UPI I can transfer the money, right, to any point of time. I can make any number of transactions. So the banking institutions accepts checkable deposits. They accept the people's savings, and they make use of this money, and individuals are entitled to use this money whenever they require it, right? So the banking system, or normally we call it commercial banks, are the very important parts of the financial institution, because basic function of the commercial bank is also that it helps in capital formation. Mobilize the savings, it accepts deposits from the public, use this money to lend the money to the people who require it, either businessmen, traders, or even individuals. You want to buy a car, you want to buy a house, right? So you don't have 1 crore rupees for buying a house. What you have is only 15 lakh rupees. What you can do is you can make the down payment of 15 lakh rupees, and rest of the 85 lakh rupees will be financed by the bank, and you pay annual interest, you pay monthly EMI to the bank, and that way you can buy the house. So these are basically the banking institution is an important component, important part of the financial institutions, right? So it may be public sector bank like SBI, Punjab National Bank, Bank of Baroda. It may be private banks like ICICI Bank, Federal Bank, Kotak Bank, HDFC Bank, like that. So these are the banking institutions. Similarly, we have non-banking institutions. These institutions do not offer banking services such as accepting deposits and lending loans. See, basic difference between banking and non-banking institution is that banking institutions accept checkable deposits. They accept such deposits against which you can issue the checks. When I use the word checks, it also means nowadays that through your whatever the credit balance of your bank is having, right, that you can make payment to anybody at any point of time, and any number of transaction you can make. When I am using the word any number of transaction, means although in the saving fund number of transaction in a month is limited, but still, whatever the small payments you have to make as an individual, as a household, right, you can easily make it. That much number of transaction normally banks allow, right? So it means they commercial banks or banking institution accept checkable deposits. Non-banking institutions like insurance companies, like non-banking finance companies, those companies which gives loan for housing purposes, those companies which gives loan against the gold, or even you must have heard the name Bajaj Finance. There are many finance companies, non-banking finance companies in India which are very prominent, right? We have insurance companies, Life Insurance Corporation of India, General Insurance Corporation of India, UTI. There are various non-banking institutions. Although they don't accept checkable deposits, but they do take money from the public in large sum of money, and they use this money to finance the companies, the large business houses, right, HNI individuals who make investments, right. So this is basically non-banking institutions are an important part of the financial institutions, right, and financial institutions minded is a very important part of the financial system. Similarly, we have pension funds, we have mutual funds. These are all financial institutions. Mutual funds, many times we have talked about this in our earlier lecture on some other subjects. The mutual funds, what the mutual fund does, they take money from the people, create a pool of money, right, and this pool of money is being managed by the professionals, and this pool of money is being invested either in the stock or in the commodities or in the debt instruments, right? The purpose for which you have given the loan, sorry, not loan, you have lent the money to the mutual funds. What the mutual funds do? They issue units, we call it, instead of stocks. In the stock market we use the word shares, but in mutual fund units, mutual funds, the mutual fund houses or asset management companies issues units. Each unit is of a particular sum of money, and they invest this money in companies. If it is a equity mutual fund, that those professionals buys equity share from that pool of funds. If it is a debt fund, they buy different securities, different debt instruments, right? If it is a commodity instruments like gold, silver, gold, these days there are mutual funds of gold also, right? So whatever the purpose for which you have lent the money, mutual fund do invest that money for that purpose, and over a period of time that money grows, right? And thereby the investors also makes profit out of it, because there is a capital appreciation. So mutual funds are the part, and the industry, mutual fund industry, is growing very fast rate in India. Similarly, pension funds. A very large sum of money people do, deposits in their pension fund. Not only deposit is being made by the individuals, but also by the employer. So both employer and employee contributes in these pension funds. And when people retire, when an individual retire, at that point of time, from that pool of fund that has been created over a period of time by the contribution of the employer and employee, the pension fund regulatory authority, right? There are certain pension fund houses which manages pension fund money. With the help of this money, they provide pensions to the individuals who have contributed during their working days, right? So pension funds or pension fund houses are also very important part of the financial system. So this is about your financial system. These are the intermediaries who facilitate the smooth functioning of the financial system by making investors and borrowers meet. Means whether it is a insurance, whether it is a banks, whether it is a non-banking finance companies, right? So they what they do is they helps in meeting the investors and the borrowers. They mobilize savings of the surplus units and allocate them into the most productive activities for better returns, right? So they provide wide range of services to the entities in the form of investment, loans and deposits, right? So this is about your financial system. Now comes the second important component of the financial system is financial markets. When we talk of the financial market, to start with, let me give the example like Bombay Stock Exchange, National Stock Exchange, MCX, right? The money markets. These are the various type of financial markets which we have in India, right? A financial market is a common place. It's like a market where the buyers and the sellers of the financial instruments meet and exchange products. These financial instruments I'll be talking, right? Financial instruments in form of shares, in form of bonds, in form of commodities, in form of foreign exchange, right? So these markets are the place where buyers and sellers meet each other and they transact these financial instruments, right? So they exchange product. What are these products? These financial instruments. What are these instruments? Instruments are stocks, bonds, currencies, right? Derivatives. I'll be talking when I will be talking in the financial instruments, right? So these instruments are being dealt in the, when I use the word dealt, it means purchase and sale, being dealt in the financial markets. So in India, financial markets can be classified as unorganized financial markets and unorganized markets. You must have heard traditionally in the villages, even in the cities, the money lenders, the Mahajans used to give money to the people who used to require this money at their requirement, at the time of their requirement. They are not being properly regulated. Even today, this system is prevalent in India, right? So there is a very large unorganized market. Even today in cities you can find chit fund companies, you can find private financing companies which do provide finance to the people when they need it. So under the unorganized market, there are large number of indigenous bankers, money lenders, traders, etc., who lends the money to the public at large through informal sources like private financing companies, chit funds, etc. In unorganized market, standard regulations and norms are framed that govern the financial trading. RBI exercises strict supervision and control on the financial transactions taking place under the market. It has further classified into two parts, in the money market and the capital market. So what you find the difference is, unorganized market is not very strictly regulated. But unlike the unorganized markets, these organized markets are very strictly regulated. They are being controlled by the RBI, that is the banker of the bank, right? They make strict control over the money market, and for the capital market, basically we have Securities and Exchange Board of India, which regulates the capital market. But when I talk of the organized markets means in a market where proper rules and regulations are being followed for the borrowing purpose, for the lending purposes, right? And it is these bodies, that is these regulators, which makes a frame of rules and regulations which regulates these markets. So in today's lecture, I'll be continuing with this markets, about the money market and the capital market, in my next lecture. So what we have discussed in this introductory lecture is basically what is financial system. That is, it is a system which has the various subsystems in form of banks, financial institutions, regulators, instruments, and the various components of it. And these components, we are discussing what are the different parts of these components. So we have discussed about basically the financial markets. We are talking about the financial markets, and we will be talking in our next lecture the different instruments of the different components of the financial markets. Thank you very much.